What about now? There we go. Recording has started.
Yep, I got it.
All right, beautiful. Adam Sypniewski of Equity Trust. We're here with Robert Costomiris of MIOYM and Adam Sypniewski, who is with Equity Trust, the newly formed partnership that MIOYM has acquired with. Thanks to them, not to us. They have graciously accepted us as one of their newly formed partners. And I'm going to turn it over to you, Adam, to kind of let us know what Equity Trust is about and what self-directed IRAs are about.
No, that's great, Rob. Really excited to join you today. I've been looking forward to our conversation. One of many, I know, but today I'm joining you to talk a little bit, about Equity Trust and what we do here with groups like yours and how we help investors like those of MIOYM's to invest more with you guys and maybe introduce a creative way that they can get involved in your deals. And so today I'm going to present a little bit about equity institutional services and what we do with self-directed IRAs, a little bit about self-direction and how that process works. And then we'll have a little bit of a conversation, Rob, to get into some Q&A and any other things that you think your audience might be curious to learn about. So if that sounds good to you, Rob, I'll go ahead and pull up a couple of slides to go through and we can kind of take it from there. Does that sound good?
Yeah, let's get to it.
Excellent, Rob. Okay, well, I'm going to start sharing my screen here in just a second. Here, let me flip over to a slideshow. Okie dokie. All right. Can you see that, Rob?
Yes, sir.
All right. So let's go to slideshow. Okay. So we're going to talk about how we unlock retirement assets to fund more investments, because that's ultimately what this is, Rob. Is when we talk about IRA dollars, they can be used towards private investments like those offered by MIOYM in the real estate space and beyond. So first off,
can I just cut you off? And I hate to do that
Yeah.
during your presentation, but it's just something.
Yeah.
Can you explain? And so I worked on Wall Street for 20 years, and a lot of people, when I would present stuff to them, you have cash accounts and you have retirement accounts, which are qualified accounts, and essentially self-directed IRA is a qualified account. Is it possible for an investor to have cash within a self-directed IRA?
Oh yeah, absolutely, Rob. So they can, an IRA in general, it's a type of retirement savings vehicle, but it can hold cash. But it can also, you can also invest that cash within the IRA into something that can produce a return, like alternative investments, or maybe the audience is more familiar with, having their IRA at Fidelity in mutual funds or something like that. What we're going to talk about today, Rob, is taking that even further and being a little bit more creative to pursue even greater yields and greater returns in the alternative investment space, particularly real estate. As we know, the S&P or the stock market, we're kind of subject to things outside of our control. When we can invest in what we know with our retirement, that can really produce some exciting results. And I think that's where we're going to talk about today. So yes, it all starts with cash in that IRA, but it's what do we do with that cash that really starts to get exciting about, I think, your audience and your group of investors.
And by the way, I was not promoting for people to keep cash in a retirement account. I just wanted to clarify that, with your regular trading or stock or traditional brokerage account, people call it a cash account, where you could have stocks, bonds, mutual funds within it. But then also with a qualified account, some individuals aren't familiar that you can have cash, although it's probably not most beneficial for growth, and especially in inflationary times, to be in cash. It's probably better to be in some sort of investment. I just wanted to clarify the difference. That's all.
No, that's great, Rob. I've been doing this so long that sometimes I forget to stop and just lay some baseline, lay some groundwork. So anytime you see an opportunity to do that, please stop me. I know this is a conversation, so I'm happy to stop and go through anything. I don't need to, stay on track here at all. Love to explore tangents and rabbit holes wherever you want to go with this, man. You just let me know.
Can you, and you might be getting into it, but can you define for us what a self-directed IRA is? Does it mean that you direct it yourself? Does it mean you're the one that does it, or is it a completely different? Like, what is a self-directed IRA? I guess.
Yeah, absolutely, Rob. And I actually, my next slide will actually cover exactly what is a self-directed IRA. So maybe we can get that up on the screen.
Yeah.
It might fit together a little bit better. But before I get to that, Rob, just a really quick primer for you and for the audience on who we are, who Equity Institutional Services is, and Equity Trust broadly. I'm again, my name's Adam. I'm with Equity Institutional Services, a division of Equity Trust. Our division was formerly known as Midland Trust, another self-directed IRA provider in the space. We'd been doing it for about 20 years when Equity Trust did acquire us in late 2023. As you can see on the slide there, Rob, and I won't get into it, Equity Trust is, what I would call like one of the OGs of the space. They've been around for 50 years, have over 45 billion in assets under custody, offices around the country, and we're known for our work, at least especially Equity Institutional Services, Rob. We're known for our work in private equity and real estate, particularly as it relates to these self-directed IRA accounts. Now that we've got that out of the way and who we are, let's get to what is this self-directed IRA, Rob? And you ask a great question. Is this a type of account? Do I need to open up? Where do I find how to open up a self-directed IRA account? I have a Roth account, I have a traditional IRA. What's a self-directed IRA? Well, what it's not, Rob, is actually it's not like a traditional, like a Roth. There's no tax status known as a self-directed account. That's really a marketing term. So for everybody listening, for everybody tuning in, self-directed IRA, that really is a marketing term that we use to communicate to the general population that the IRA account owner, you yourself, are picking and choosing these assets, these investments within your retirement account. So, Rob, you asked a cash account versus, what do we do with that cash in the IRA? This is where that self-direction comes into play. Again, it's not a tax status of an account. It's just to communicate this idea that we're picking and choosing our own investment opportunities within our IRA account, particularly private investment opportunities, alternative investments, non-traded investments. So when you talk about your history on Wall Street, Rob, we're not talking about mutual funds or self-directing your IRA into Nvidia stock or something like that. We're talking about Rob finding an opportunity with MIOYM to invest his IRA in, and that being something that they want to do. That's self-direction. So does that make sense, Rob?
So it's using qualified funds to be able to invest into private or something that's like an alternative investment as opposed to traditional mutual funds, stocks, bonds, things of that nature that Fidelities and the Merrill Lynches get into, correct?
Yeah, exactly. So a lot of our clients, Rob, they'll have that account at Fidelity or at Merrill or whatever it might be, and they'll have their basket of traditional assets there. But they our clients are, they're sophisticated, they are motivated by diversification, and really capturing returns in all segments of the market. And so they have that basket of securities at Fidelity or Merrill, wherever it might be, Rob. But then they'll also open up this, it's almost like a sidecar IRA of their retirement portfolio to hold their alternative investments, their real estate, their private equity deals, whatever else. You can see that we do a couple other things there on the slide. But that's the thinking, Rob, is that yes, we're coming away from kind of those publicly traded items and diversifying into an alternative investment, and therein lies the beauty of self-direction.
Right, and one thing that I focus on immensely, especially when I was on Wall Street, is to have a well-diversified portfolio. I'm not saying that people should only go into real estate or have only a self-directed IRA. Although I wouldn't mind just being in the real estate world myself, I tried to get people to diversify their portfolios. Little disclosure there.
Yeah. No, what's good for you is good for me, Rob. So I'm all for self-direction, and obviously this is where I've made my name, and my bread is buttered by raising awareness, and that's why I'm so grateful to be here and let your audience know about the advantages of using self-directed accounts and how it can really maximize retirement growth and retirement planning, because that's what this is about, and that's what this slide kind of takes us through, Rob. Is just that self-direction opens up new avenues in terms of how you want to, like we said, diversify, but also what we can earn. You can own VOO or VTI in your portfolio. Some ETFs that people trust and know that'll give them that 7%, 8% per year. But what about that 15, 20 and beyond, returns that people are seeking and want to branch out to find? That's where, this advantage of self-direction really comes into play. And I'd also mention here, Rob, that unlike Wall Street, we're not trying to, we're not here in a position to provide you advice. We're not your advisor. We're not here to talk you out of something that you came to us to do. We're actually prevented from that type of activity because we only provide these self-directed accounts. In other words, Rob, we're not Wall Street brokers. We're not trying to, we don't earn a commission on the products that you buy and put your retirement money into, like maybe a Schwab or a Fidelity advisor might do. So this really is putting the power in the hands of the investor, of the consumer, and allowing them to use their retirement money to do something that they feel it works with their plans, that they feel passionate about, that they understand, that their due diligence, their underwriting leads them to believe that this is a great investment opportunity for their retirement account. So not too much.
Yeah, I'm sorry. I don't mean to cut you off. I just have one question for you. And I know, myself as being partnered with Equity Trust, what the benefit for MIOYM is. It opens up a whole new realm of, investments that we have the ability to take, utilizing Equity Trust as a tool within our toolbox, or our client's toolbox, if you will. What is the benefit of a client to go through Equity Trust? And it doesn't have to be Equity Trust specifically. Obviously, we want them to go through Equity Trust, but a self-directed IRA and also Equity Trust. What's the benefit? Because you just said that you guys don't give advice. You're basically just, a custodian. You didn't say that. I'm saying it. What's the benefit of them using Equity Trust?
Yeah. So again, we're on the same side of the table as the investor, right? We're here to empower them to achieve what they're looking to achieve, not to coerce them into some investment or some type of plan that benefits us. We benefit when the client benefits, and so that's why we recommend Equity Trust and self-direction as a great way for folks to really achieve what they're looking to achieve as part of their wealth strategy. So and even taking a step back from that, Rob, take Equity Trust out of it. If you want to use your IRA to invest it, in some of these alternative products, you're avoiding those capital gains, tax liabilities, because you're investing under the umbrella of your IRA. So in a lot of cases, you're avoiding any sort of tax hit right away. You're using it as a strategy to mitigate that tax hit, ideally when you're in retirement, and that you can find a way to kind of limit that tax hit, that might come by way of your returns. So when we look at this IRA investing itself, Rob, the advantage is, my tax situation is a lot easier to handle. I can keep a lot more of what I'm earning.
Well, you basically keep all your earnings or growth until 59 and a half, 70, whenever you decide to start taking it,
right,
when essentially your taxable event would be at a lower rate, allegedly, assuming that you're making less money.
That's the philosophy, right, Rob? And again, I'm not a CPA, I'm not a wealth manager, but anecdotally speaking,
I was going by the overall aspect of the benefit of tax deferral, because you were saying that you're not paying taxes right away, and I'm saying you keep all that growth for all that time, and you don't have to pay taxes until you take it. And the benefits of taking it is it's deferred income at that time. Not deferred. You're deferring the taxes until you're ready to take it when it's at a lesser taxable event. That's me saying it, not you. So
yeah, no, and that, but I can support that. Take that a little bit further, Rob. That yes, or just kind of clarify the point for the audience that when we look at IRAs, the taxation of IRAs with traditional IRAs, they're taxed as regular income when we take assets or cash out of the IRA. So if I call up my IRA custodian and say, hey, send me $50,000, they're gonna produce a 1099-R for $50,000 of income for that year. And if I'm under the age of 59 and a half at that time, I get an extra 10% early withdrawal penalty tax on top. So just to further that point, Rob, that we wait till 59 and a half to take that cash or money out. We're not in that same income tax bracket that we are now, when we're working and earning considerable income that puts us at a higher rate. we can mitigate in retirement by taking distributions after 59 and a half, keeping that into a lower tax bracket. And that's where you're going. And that's absolutely part of the strategy here that I can't illustrate with great detail because I'm just not educated enough, but that our clients are passionate about pursuing with their own strategies. Maybe they're advised by their CPA or wealth manager. It's all a part of it. So it's a great question to think about right now as we talk about the advantages, Rob.
Yeah, sorry, I got you off on a tangent there. I apologize.
No, this is great. This is what, there's so many tangents and rabbit holes here that we can explore, not only in this conversation, but in future conversations. I welcome it, Rob. No apology necessary, man. Let's talk a little bit about, why folks, do self-direction. What motivates them to go the self-directed route? Well, we've already touched on a couple of these, Rob, right? The diversification, I think, is the big one, right? We can't all own NVIDIA stock. We can't all, have all of our eggs in one basket, right? So by branching out into things like real estate, venture, lending, all those things are things that our clients do. They're passionate. That's why self-direction is attractive to them, that diversification. But we also see a couple other things. We talked about tax mitigation just a couple minutes ago. But I think the other two boxes on the screen, Rob, are points that we'd like to make too. Illiquidity. A lot of times folks will find themselves in front of MIOYM deals or other types of deals, and they know it's attractive, but they just don't have the cash for it, right? They're not liquid. Maybe they're between jobs. Maybe their cash is tied up in their primary home, or who knows, or maybe it's tied up in other investments. A lot of folks have that investable wealth within their retirement account. I think it's something like, and don't quote me on this, Rob, but I think it's something like 70% of an American's investable wealth is in their retirement account. So if someone's investing directly in a taxable account, they've got more than double that investable wealth sitting in a retirement account in theory. So let's use that money to access this deal. I'm illiquid. I don't have cash. I'm just trying to pay my bills. But man, my retirement is considerably grown because I've been working for years and I've had my 401k match. Well, let's use that bucket of money to invest in a deal. So that illiquidity, I think, is a big motivator for our clients that believe in what an investment sponsor might be doing from a strategy perspective. They don't want to miss out on a deal. They can earn those returns in their retirement. Yeah, they might have to set it aside for a couple of years before they can access that cash. But the point being that at least they got into that deal one way or another. They knew it would help them, maybe not today, but on a rainy day in retirement.
One other thing that IRA accounts do in general is it gives, just touching on your illiquidity conversation there, is that it puts a time horizon in perspective for some people. Because, working, on Wall Street and speaking to clients, and you say, what's your time horizon? And people are like, well, I don't know. What do you mean? What's that? I don't know when I want to retire. I don't know, what this looks like. I don't know. They just don't know. It's not something people think about all the time. Like myself, I don't really have any intentions of retiring anytime. I'm going to work basically until the end of days for me. So, and that's by choice. That's not like, because I feel the need to. It's just, what else am I going to do? Will I work to, 12, 14 hours a day? No, I'm not going to do that. But I plan on working my entire life. So when I say to somebody, or used to say to somebody, what's your time horizon? I'm going to say a good 75 to 80% of the time, it's, I don't know. But when you're talking to somebody about specific investments and they say they don't have cash, or, whatever the case may be, or they don't feel like using their cash or the money in their bank accounts, and they say, well, I do have an IRA account and I can't touch that till I'm 59 and a half, it automatically puts a time horizon on it for them. So they know that they can't use it till they're 59 and a half. So they know they could take X amount of risk with it, depending on where they are in their lives, the 30, 40, 50, whatever, they know how much risk they could take. And in there, they could visualize exactly what their time horizon is. It's pretty silly scenario, but I've noticed it more and more with people that once I say, do you have any IRA assets? And they're like, oh yeah, I can't touch that till so I could use that. So just touching on your illiquidity, they already know that they don't have liquidity within that. So they don't mind tying it up, because if you say we have 12-month, 18-month, 24-month projects, generally that's our time horizon. So they know that within 24 months, on the longest term, they'll be liquid. that's before 59 and a half, so I'm good. So they don't really care. So just something that I've noticed and I wanted to kind of put out there.
No, that's an excellent point, Rob. And yeah, it just validates kind of what we both see on this side, right? Because when I'm talking to folks that are setting up IRAs, they also think, hell, I can't touch this money anyway, so it's not like it's leaving me cash strapped to invest in this deal. It's in my retirement account, so I'm going to be a little bit maybe more. I don't know if cavalier is the right term, Rob, but just their risk appetite is different.
Exactly. What you're saying is like basically just, confirming what I said is like they may not know what their risk tolerance is. They may not know what their time horizon is, but they know that they can't touch it till 59 and a half. And let's say I'm 30, they know they have, almost 30 more years till they can touch it.
Yeah.
If they're 40, they know they have 20 years. If they're, 50, they only have, 9, 10 years. And it gives them that time horizon so they know their risk tolerance and they can, take the necessary risk. I used illiquidity, but the risk tolerance comes into play there because they could, at that point, they visualize what it is, and that you just basically confirmed it on the risk tolerance side. I was using it as the time horizon.
Yeah, no, it's all. I mean, it all just furthers the point that this is a great option if you have that horizon. That this is a great option for you to get involved and start building your retirement. With more ferocity, with more velocity, and it's going to build up a much more considerable balance if you're diversifying into some of these alternative deals. So great points there, Rob. I didn't, you helped me even kind of harden the point for me. The last point on this slide, Rob, pretty simple: job change. We don't always know when we're going to lose a job or change a job, but if we do, and we were contributing to an employer plan and we had that match, we can use that balance to roll into a self-directed account. So that's what motivates our clients to do the self-direction too, is that like, hey, I've changed jobs, Adam. I don't want to roll into my new company's 401k and just, invest in target date funds. What can I do with this balance? Well, take that 401k, you can do something creative with it. You can self-direct it into something, with MIOYM or otherwise. And so that's just another motivator for our clients, or at least that drives them to setting up or going the self-directed route. And when we talk about that, Rob, this is important too, because the job change, that is a significant. I specifically mentioned that because as we might have kind of covered earlier, Rob, or at least touched on, those old employer plans. When I mean old, I mean separation of service, meaning you've left that company, you no longer work there, or you've retired. Those employer plans that we've contributed to, our 401ks, our 403bs, thrift savings plans for the veterans out there. Once we have that separation of service, that plan becomes portable. We can roll that money over into an IRA without any liability. When we're active in a 401k plan, like I'm employed by Equity Trust, I'm in their 401k plan. I cannot access that money because I'm not 59 and a half and I'm still working for Equity Trust. I cannot roll that balance over to self-directed, to a self-directed account. So we're always talking about old 401k money, and that's why I talk about that job change on the previous slide, Rob. That I think is an important point that, especially in a tight labor market when people have been changing jobs, jumping from job to job. I mean, shoot, in the pandemic a few years ago, Rob, we had people having multiple jobs. Those old employer plan balances, you can consolidate that into an IRA, or you can diversify into a self-directed account. It's like, once you leave that job, you're free to kind of invest in some other more exciting things. And then, that's probably the second most common way that folks set up a self-directed account, or how they fund that self-directed account, with the most common way being what we talked about earlier, Rob, where, existing IRA money elsewhere, where folks come to us with 100K coming from their Schwab account, or 250K out of their Merrill IRA. That's the most common way we see folks set up a self-directed account, is that they've had an IRA today, they just want to peel off a piece of it to start self-directing.
So what types of accounts or IRA or qualified accounts can you open within a self-directed IRA account?
Yeah, you can self-direct a couple different of account types. There's, obviously, everybody knows our traditional IRAs or pre-tax accounts. We can also self-direct Roth IRAs. Those are post-tax dollars. We can also self-direct the SEP and simple IRAs, which, Simples aren't really, talked about much anymore, but SEP IRAs are great for your business owners that might be in the audience because SEP IRAs, that's SEP or Simplified Employee Plan or Simplified Employee Pension IRA. The SEP IRAs, again, for business owners, they can contribute even more than the typical $7,000 a year that folks can contribute to an IRA. A SEP IRA, Rob, you can contribute as an employee and an employer to now where in 2024 you can get almost 60 grand on an annual basis into a SEP IRA. Again, not everybody's eligible for that. You have to own a business, and there's some other boxes to check that we could talk about, have a conversation about. But those are the types of accounts that we see self-directed, Rob, at least on the IRA side. And then there's some other actual account types that we support here at Equity that you could self-direct as well. Also for the business owners, individual 401k plans or solo Ks. Those are really exciting plans that have a lot of nuance that I don't know that we want to talk about too much right now, Rob, but we could maybe even have a whole nother conversation around solo 401k plans and what those are. But you can self-direct that, and you can self-direct your HSAs, your health savings accounts, and your education savings accounts, your ESAs. But again, we mostly see the IRAs being set up to self-direct, Rob. Again, that's your traditional IRA, your Roth IRA, and yes, we do see a significant amount of SEP IRAs from business owners that people self-direct. Does that all make sense? Did I answer your question?
Yeah. What about, and this is more for business owners and bigger, much higher income earners, defined benefit or defined contribution plans? You don't have to get into details of the nuances of them or anything like that. Can you hold them?
We cannot hold them because they are, in most cases, group plans. They aren't individualized. We can only support in the self-directed space, at least at this time, individual accounts.
So I've had clients that are, they work for themselves, but they have a defined contribution plan just because they make $1 million plus and they want to put away much more money than they normally would within anything else. Can you, if it's just an individual, can you hold it, or am I kind of pigeonholing you with that question?
You're not pigeonholing me, Rob, but we just don't support the defined contribution plans because it's more I think from a tax reporting perspective, we're
they're a little more complex.
It just doesn't probably fit our core competencies. I mean, we see clients that fund from DBPs. That they might have already retired or something like that, or they had that separate.
They could roll it over into an IRA or something. No, I know that. I was just, I get that question a lot: is can I buy in my? And that's what I tell them is you might want to roll it into a traditional and then roll it into a self-directed.
Exactly. But these are all great questions, Rob, and I really don't have too much more for you or for the audience in terms of this presentation. Just a little bit about how do you get started? It's all online. We have a website where you'd see how to set up that I got linked there at the bottom, Rob. Again, that is correct. It says apply.midlandtrust.com. Again, I'm still like part of this Midland Trust legacy team. We're still kind of using some older branded legacy products, but we are Equity Institutional, and you can find me and my information right there on the screen. I welcome anybody to give me a call, shoot me an email, Rob. As I've told you, I'm a resource for you and for your LPs and for your network. So I welcome anybody to give me a shout if you're thinking about the self-directed stuff.
And I have to say, sorry. Go ahead. Please finish.
No, I was just going to say that's really all I had from a presentation standpoint. So I don't really need to keep my slides up here any longer, especially when my headshot's up there, Rob. But would love to kind of chop it up with you from.
It is a good headshot, though. You should keep it up there. So one thing I got to say is, one thing that is good, and I noticed it because, I was emailing you about a client yesterday who already had an account with Equity Trust, so it didn't go through you per se, but you guys have account representatives designated for people who have accounts with Equity Trust. And the benefit to that is, what most people may not know, is you're not calling an 800 line. You're actually speaking to somebody who could answer specific questions designed specifically for you. Some people like that. Some people don't like that. I personally like that when I'm dealing with somebody because it's somebody who knows you, and they may not know you personally, but they just can pull up your account and know your account, which I think is a very big deal, which you had answered a question for me. I went back to the client, and within 15 minutes, this was email wise. So, 15 minutes in email time isn't long at all. He came back to me and said, this is what I need from you guys to start this. And I just had to change some paperwork to send it, the titling of the account back to him.
Excellent.
One question that I, wanted to ask you is, so buying real estate is, we have a product where we invest into, our properties and we give a nice return, a 17.5% return. We give out K1s. So it's a higher tax benefit or a higher taxable event if you don't have write downs, or if you don't know how to use a K1, or you're a business owner for that matter, which most of our clients do, and I try and help them through that. You answered it already, but what is the benefit of having a self-directed IRA account and being able to defer that 17.5%? Let's say if you're 40 years old, you're deferring it off.
Yeah, because when we use our IRA, to invest, Rob, that K1 really doesn't apply to us. I mean, like we'll get copies of K1s, but like shredder or into the recycle bin, because that you're just not complicated from a tax liability perspective. With the exception of in some limited cases, there might be some UBIT tax, if you've ever heard of that, Rob. That's a whole nother ball of wax that we don't need to get into today. But if sometimes in some limited cases where leverage is introduced inside of a deal, there might be a small tax introduced called a UBIT tax. That would be the only thing we ever need from a K1. Otherwise, when we're investing with our IRA, that K1, like I said, it can be saved for some bedtime reading maybe, but that's really it. Because again, you're under the tax shelter of your IRA. So if you're 40, doesn't really matter what that 17.5% is coming in. Like it doesn't really add to your tax liability for that year because it's being sheltered within your IRA. And as we touched on before, Rob, you can sit on that cash, let it, whatever it's going to do. Maybe you're investing it in something else over the next bit of your, horizon, as we talked, from 40 to 59.5. You're retired, you're earning less. You can just drip that cash out of that IRA to, mitigate that tax liability, ideally in retirement. Again, not formal advice, but I think the audience knows exactly where we're going with this, and that's the whole philosophy.
One of the ways I use to describe it is if you're investing 100,000 and you're making 17,500 with us, you're making 17,500. Whereas if you're in a regular account, that 17,500 is minus 10, 20, 30%, whatever your taxable event is. And I'm not saying that anybody's at a specific, taxable bracket, but, we do have to pay taxes because Uncle Sam does have to keep operating. But instead of, having to worry about, okay, so I made 17,500, but I actually only made 15,000 because I got to pay, a couple $1,000s to Uncle Sam. When you're in an IRA, and let's say, and I'm only using 40 because it's kind of somewhere right in the middle. That 17,500, you could take it and roll it into the next deal, roll it into the next deal, roll it into the next deal, and that can compound into something nice by the time you're ready to retire at 59.5. And by the way, I'd like to be introduced to those people that are retiring at 59.5.
Yeah. Who is
this
that?
This day and age, it's a little tough.
Yeah, but you know what? You're actually revealing an even more powerful point, Rob, I think, and that's that, within the IRA, they're keeping more of their returns, right? They're keeping their money and they're able to use more of it to the next deal. So like that compounding effect is super powerful because not only are you keeping more of that income, but you can use more of that in the next deal. So you're earning even more. So like think about how powerful that can be over the course of 19.5 or even more years, if you're under 40. So it's a very powerful point that you're illustrating for sure.
Yeah. And one thing I wanted to touch on, because I know you have to go. One thing I want to touch on is a lot of times I get questioned is like, well, why aren't you on like a Morgan Stanley or Merrill Lynch? And we are a very small company. I will not deny that. We only have, about $50 million under management. So like a company like that won't touch us. But one of the important things is they won't touch us because we can't price our product, and real estate isn't priced on a daily basis every 24 hours. So like if they gave us 100,000 today, tomorrow that 100,000 is still only going to be 100,000. Whereas when you own, like the QQQs or the SPYs, it's got a different price overnight, and it changes on a daily. It changes by the second, but they could price that account on a daily basis, which we don't have the opportunity to do. We're not big enough to actually have that. But with with the ability with equity trust and self-directed IRAs, we don't have to price it. It's just they give us a certain amount on point A, and when they're done at point B, let's just call it 12 months later, and we're supposed to give them 17.5%. We give them, they gave us 100,000, we're giving them 1,117.5 back. And that's all that equity trust is concerned about, is that we upheld our end of the contract and we paid them exactly what we were supposed to pay them. So that's the benefit for us as MIOYM, aside from the fact that it opens up a whole new realm. It's not so much that we're, too small, they won't look at us. We're actually in a couple large large financial companies, process. We're in there. We just have to keep them updated what's going on. And once we get to a certain point, they'll take a look at us. But it's not because we're too small, it's because we can't price it out. And whereas self-directed IRAs, they're more concerned with the overall investment as opposed to a daily price.
Yeah, and I mean that's another point that really didn't come up in the presentation, Rob. But the Merrills of the world, the Fidelities of the world, regardless of MIOYM's size, they just tend not to hold any sort of private investments because they want to put them through a due diligence, or they want to get more assets on the books before they'll even accommodate your request. Our self-directed companies like Equity Trust, we don't do anything like that. That's not our game. Our game is to help these investors get an IRA account opened and set up as quickly as possible to get into a deal that they've chosen. So again, Merrill Lynch, Fidelity probably won't accommodate. Like if you held up your hand and said, I want to invest my IRA in MIOYM, your Merrill Lynch advisor would tell you it's a bad idea. Don't do it. You have to come to a company like us, because guess what? You don't have an advisor that can take fees on what you're investing in your self-directed account. It's it's the consumer, it's the investor, the sophisticated party, the LP making this decision to do this. And usually, as you know from your time on Wall Street, Rob, I'm sure wirehouses want to keep assets on books. And so, when you go self-directed, they're losing a little bit of something of self-interest there. So that's why, the larger custodians, the Schwabs, the Fidelities, the Merrills of the world don't always support the self-direction. And you need to actually find a self-directed company if you want to do this. Fidelity might tell you, hey, Rob, you can self-direct your IRA with us. You can pick and choose whatever stocks you want. But that's not what we really mean.
Right. Although it is self-directed, you are directing it yourself. It's not a self-directed account. But most when I speak to Fidelity, when I speak to the other firms, they will say that they don't deal in self-directed accounts. But most people don't understand that.
Exactly. There's a little bit more nuance, as we know, on the slides.
Yeah. Well, Adam, I want to be cognizant of your time. I appreciate your time. I appreciate the partnership and the ability for MIOYM to be presented alongside Equity Trust. So thank you very much. And I appreciate the information that you provided today.
Oh, it was a pleasure to be here, Rob. I'm really grateful to count you amongst the relationships that we have here at Equity Trust, and really excited about what MIOYM's doing, and look forward to meeting more of your LPs and helping them on this successful journey to building their retirement wealth. So thanks for having me.
Adam, have a great day.
You too, Rob. Thanks.